Here's an uncomfortable fact. If tomorrow the country you live in decided to stop printing its currency, the ripple effects wouldn't just hit your neighborhood or your state. They'd hit oil prices in Nigeria, loan repayments in Argentina, and grocery bills in Pakistan. That country is the United States. That currency is the dollar, a currency controlled by one government with a grip on the entire planet's economy. And the real question isn't whether the dollar is powerful. It's how one nation's paper became the backbone of a system it doesn't even fully control anymore. This question keeps resurfacing because every few years, someone declares the dollar's reign is ending. China pushes the yuan, Russia dumps dollar reserves. BRICS nations float the idea of a shared currency. Headlines scream, the dollar is dying. And then, months later, nothing has actually changed. So the real mystery isn't whether the dollar is strong or weak right now. It's why a system this contested has proven nearly impossible to dismantle. To understand that, you have to go back to how this system was built in the first place. Every country prints its own money, but when two nations trade with each other, they need a shared currency both sides trust. That trust isn't something economists can just legislate into existence, because a currency's value lives on perception, not paper. In 1944 at Bretton Woods, the world's major economies agreed to peg the dollar to gold and peg every other currency to the dollar. Overnight, the dollar became the anchor of global trust. In 1971, the US severed that gold link entirely. By then, though, the dollar was so deeply wired into the system that it didn't need gold to hold its position. Today, most of the world's oil is still priced and traded in dollars, a setup often called the petrodollar system. When Saudi Arabia or Iraq sells oil, the payment is almost always in dollars, regardless of who's buying. That single fact sets off a chain reaction. If oil trades in dollars, every country needs dollar reserves. If every country needs dollar reserves, every country needs dollars. And once every country needs dollars, that demand never really goes away. Now here's the math nobody wants to sit with. US national debt crossed $36 trillion in 2026. That number is so large it barely registers as real. If any other country carried debt like that relative to its economy, its currency would collapse, investors would flee, and the IMF would be at the door within months. But that's not what happens to the US because the rest of the world keeps buying its debt voluntarily. China, Japan, India, dozens of nations hold US Treasury Bonds because they're sitting on dollar reserves that need to go somewhere. And the safest place to park them, ironically, is the debt of the very country that owes the most. It's a closed loop. The world funds America's debt, and in exchange, demand for the dollar stays alive, which means the US effectively exports its financial risk to everyone else, and the rest of the world absorbs it without much of a say, because the alternatives look just as risky, if not riskier. This is where the gap between hype and reality becomes obvious. Every year, headlines insist de-dollarization is underway, that BRICS will launch a rival currency, that the yuan is about to dethrone the dollar. The reality is that the yuan makes up roughly 2 to 3% of global reserves, while the dollar still holds more than half. China doesn't even let its own currency trade freely because it wants tight control over capital flows. So the one country most often positioned as the dollar's biggest challenger won't open up its own currency the way the dollar is open. The euro looks like a contender on paper, but Europe doesn't have a single unified bond market the size and depth of America's, somewhere investors can quickly and safely park capital. The uncomfortable truth is that replacing the dollar doesn't just require a strong economy, it requires an entire architecture of trust built over decades, and no other country has managed to build one that matches it. Zoom out and the stakes get even bigger. Every time the Federal Reserve raises or cuts interest rates, it's not just an American story, it's a global one. When the Fed raises rates, the dollar strengthens, and countries that borrowed in dollars suddenly see their repayment burdens spike overnight, without their own economies doing anything wrong. Sri Lanka, Pakistan, Argentina, all three of their recent economic crises were shaped in part by dollar movements, not just domestic mismanagement. That's a kind of power no election grants and no treaty formalizes. It exists purely because the world has collectively agreed again and again that the dollar is the currency worth trusting. Whatever policy the US runs domestically ends up echoing from stock markets in Mumbai to fuel pumps in Lagos. So the real question was never about power, it's about dependency. The world has wired itself so deeply into the dollar system that stepping out now feels nearly impossible, no matter how much political will exists to try. It's a trap everyone can see, but no single country can afford to exit alone, because if one nation drops the dollar while everyone else keeps using it, that one nation absorbs all the damage. It's a bit like a room full of people standing on an assumption everyone privately knows is shaky, but nobody wants to be the first to move. So next time you hear that the dollar's collapse is coming, ask yourself something. If the world's most powerful currency is only powerful because everyone agrees to trust it, what happens on the day that trust breaks? And if that day comes, will the world actually be ready for it, or will it already be too late?